So the S&P didn't bottom until mid to late March 2009, and that whole time the precious metal sector was still rising. And that's kind of what I expect to see again this time. I think we're starting to see signs that, the variables are being put in place for that type of move to happen while the stock market continues to head lower.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me back on, Elijah. Good to be here.
Well, it's great to see you. I did want to discuss the Commitment of Traders report. It seems like it's very bullish right now. That's what I've been hearing. And you recently stated on Arcadia Economics that this is the most bullish report you've seen. So your perspective on that?
Well, I mean, it's the most bullish report that I've seen in recent memory. I mean, I'd have to go back and parse all the data. You can get the Commitment of Traders historical data back at least to 2006, but it's kind of a pain. You gotta download a one of those compacted files and then unpack it, and then you gotta weed through all the categories. So maybe I'll do that Labor Day weekend. But it's bullish from the perspective that especially with silver and gold, the hedge funds have repositioned themselves so that they're very net short silver. Now I'm talking about paper silver, paper COMEX futures, and I'm talking about their gross long position net of their gross short position. And over, the past 5 or 6 weeks, they've moved from being net long to being very net short. And I'd have to go back and look at the data. But I mean, as of a week ago Tuesday, because that's what the cutoff date is for the COT report, the hedge funds were net short about 18,000 contracts, which is a pretty big net short position. And at the same time, the banks, which is for people who want to pull up the Commitment of Traders report, it's the swap dealers category. They've moved from a very net short position in COMEX silver futures to a fairly big net long position, meaning their net long position exceeds their gross long position exceeds their gross short position by about 15,000 contracts. So, and then the other thing that was interesting is that in both silver and gold, the producer user category. So presumably to the extent that there might be some mining companies who hedge their production, a small amount of their production using COMEX futures, or, jewelers who might hedge out the net price to them in gold or silver, for silver and gold that they buy to make jewelry. They've been substantially reducing their hedge, meaning their net short position in both gold and silver. So, and then also, and I can see this coming in gold. It's rare when the hedge funds go net short paper gold, and over the last couple weeks, they're now net short almost 20,000 contracts of gold futures. And that's a pretty aggressive short position. And then similarly, the banks, I don't know if I've ever seen the banks net long paper gold, but they've been aggressively reducing their net short exposure to gold futures. So historically, and this isn't always the case, but historically, when the Commitment of Traders is positioned like this, especially after we've had a pretty steep sell-off in the prices of gold and silver, it tends to correspond with tradable bottoms in the sector. Now, that's not to say if the stock market has another abrupt down leg, and I think it will at some point, that's not to say that the hedge funds won't be dumping everything, including, dumping more gross long positions in gold and silver and increasing their net short positions. But, by the same token, that will also, when the market snaps back from a sell-off like that, that will also intensify the rebound, because the hedge funds, these guys aren't positioning in COMEX futures for a fundamentals based long term trade. I mean, they use it as, I think they partially use their gold futures, as part of their when you're marketing your fund to pensions, you want to show as low a Sharpe ratio as possible, and having an asset in the fund that is, to some degree inversely correlated with the stock market, that'll reduce your Sharpe ratio, your risk, the various volatility risk factors that professional investors look at. So, and then I also think they kind of just trade it around like the way the banks do, and chasing momentum in either direction, especially the hedge funds.
So what do you think are the fundamental reasons we're seeing the shift right now of the banks going net long and the hedge funds going short?
I mean, again, if you look through, the most recent glaring example is when we had a bear market, about a 4.5-year bear market between 2011 and the end of 2015. And this setup looked similar to this. And again, I don't remember the relative magnitudes back then versus now. And again, I'd have to look. But back then when the banks went net long, substantially net long paper silver, and the hedge funds went net short, and this occurred. So the market kind of bottomed and started heading higher right at the end of December, early January. And the short position, the structure of the COT looked like this that fall. So, I think the banks maybe have gotten to the point where they've decided, they can't push the market down anymore unless they get some help from the stock market with another waterfall decline. And I think they're reducing their risk exposure to being short gold and silver. There's a chance also that the Basel III Basel III regulations that aren't enforceable but have been put into place. There's a chance that it may also be part of their reducing the overall risk exposure of their balance sheet in accordance with Basel III. I don't know. I know there's some people who have that view. But, either way, to me, I don't really analyze. I used to analyze the COT every week and the open interest every day. And it just, to some extent, I don't necessarily trust the numbers, I think. But when the structure of the COT gets to an extreme level, which is when the banks go net long, at least silver, and they're reducing their net short in gold, and the hedge funds are net short both. That's when the commitment to traders report gets interesting to me. And again, it's more often than not, historically, it's marked at least a short-term tradable bottom, if not a longer sustained move in the sector.
I know last time we had you on, you were mentioning how mining stocks relative to the stock market were more undervalued than they had been since 2002. So your perspective on that, you had mentioned, it seems like we're kind of at that washout period. Do you think precious metals could fall lower from here?
I mean, again, you got to talk about, it's a two-tier market, right? It's the physical market, and it's the paper market, the paper derivative market, and the unallocated physical market in London, and really on the COMEX as well. But the COMEX isn't really a physical market. So, we're in a period of time right now where India is kind of dormant. It's on a seasonal basis. It's ahead of their festival and wedding season that starts this fall and goes through Christmas. And it's also, the farmers over there who are large gold buyers when they harvest their crops and they convert it into rupees, and then they convert that rupees into physical gold, whether it's coins, bars, or jewelry. And that's every year. That's the cycle. So, but it's a period of dormancy over there right now, and there's been some other technical issues with the value added tax, and or not the value added tax, the import duty tax that is imposed over there. That was nudged a little bit higher this summer, and so this is just seasonally the quiet period for the Indians. So there's not that pressure on the entities that are shorting gold and silver derivatives to have to worry that much about coming up with physical gold and silver that has to be delivered into India. And China's been somewhat quiet, although the activity of their buying has picked up. And my source of all this data is a report by John Brimlow called Brimlow's Gold Jottings, and it's kind of a pricey 2 to 3 times daily update on the global gold market. And one of the reasons we specifically get it is to get the data that he provides from the Indian market. Well, really, most of the major Eastern Hemisphere markets. So, but I think that I think as we go further into August, you're going to start to see physical buying in the Eastern Hemisphere start to pick up again. And, that tends to correlate with a general uptrend in the price of gold and silver. So to circle back to your original question, do I think the price of gold and silver can go lower from here? Yeah, of course it can. But I'm talking about the paper market, the COMEX futures, LBMA forwards, OTC derivatives. They can, those things can be used to push the derivatives price lower, but that's not the price that they're paying in the Eastern Hemisphere for physical, especially the Indians, because their import duty tax now is something like, it's over $300 an ounce. So when they're buying gold, they're paying, the price that you see on your Kitco screen plus over 300. And we're seeing the same thing to the extent that, there's some upward pressure on the physical market from the retail side. We're seeing the same thing with premiums, especially in silver products at coin dealers. So, but yeah, again, if we get another serious downdraft in the stock market, then I think the hedge funds are going to continue the trade that they were doing that led them to their net short position in silver, which is they go long the dollar index and they short euros and yens against that, and they short paper gold and silver against that. So, and that's, to me, that's been the major factor that's pushed down the price that we see on our screens every day. And if you track overnight trading over a longer period of time, you can see that I would say at least 80% of the time the gold price rises in late evening and early morning, Eastern Standard Time. And then as soon as the Asian markets close down, which is usually between 2 and 3 a.m. Eastern Standard Time, all of a sudden that's when London takes over, and boom, they start pushing the price down into the London AM fix. And that's a repetitious pattern that's been going on for years and years. And it's been going on, in a major way the last 2 or 3 months.
Mentioning that disconnect, it seems like, over the last 2 years especially, we've seen elevated premiums in physical product. And even like here at Miles Franklin, we've been talking about, we just put out a video actually on Liberty and Finance about how the premiums go both ways. And right now we're seeing an anomaly with Silver Eagles, where we'll actually, for a swap, purchase back Silver Eagles at above $10 over spot. So it's just, wow, it's a very interesting physical market out there right now.
Yeah, no question about it. And I think that's why the banks are reducing their paper gold exposure, short exposure. And I think it's why they've gone net long paper silver.
And your perspective then on, I guess, the market going forward, because I know you've been stating recently that it seems like we're headed towards major issues in the financial system, and this could cause the Fed to pivot. So that would definitely be very bullish for precious metals.
Yeah, the thing is, I'm not convinced the Fed's going to do a pivot this year. I know that that's what the market thinks, and that's what the market's pricing in right now with this crazy bear market rally that we've had. But since the FOMC meeting, but I mean, if you go through the FOMC policy statement word by word, they basically say that they believe it's appropriate to continue hiking rates for the next several meetings. And I mean, they do say, but it'll be data dependent at each meeting. And I think that's what the market found to be leaving the trapdoor open for them to say, oh, well, inflation's moderating. And, all signs are that we're headed to a recession, even though we're already in a recession. So I actually think, as opposed to whether the personal consumption expenditures index is running at 4.8% or 4.9 or 4.7. I mean, if it ticks down from 4.8 to 4.7, which it didn't in the last GDP report, it still was elevated. And I still think it's incorrect to use that as your inflation gauge, but that's what everyone thinks the Fed looks at. If the market ticks down, we're in a market right now where if it goes from 4.8 to 4.7, oh, inflation's peaked. Jim Cramer was out, I guess, on CNBC, or did a tweet that said, peak inflation is past. Why? Because it's peak inflation is past. That's what he said. And there's no way. I think it's going to continue getting worse. I mean, they can manipulate the official data and try to make it look like it's moderating, and maybe they will, ahead of, in the next couple months, so that the Fed would pivot to support the Democrats in the midterms. But I mean, every single FOMC member voted in favor of the policy statement that was released. And it's been a while since we've seen a unanimous vote on the policy statement. And that policy statement said they plan to continue hiking rates. And then we had a whole slew of FOMC voting members come out starting over the weekend. And they basically said the same thing. We're not seeing prices moderate. And they point to a low unemployment rate also. The labor market's still very strong. And so as long as, their supposed dual mandate is price stability and full employment, right? So as long as the manipulated federal data is going to show us that the unemployment rate is wherever it was in the last report, 3.2 or 3.5%, as long as it's showing that unemployment rate, the feds can point to that and say, see, labor market's still tight, we're at full employment, and we're still seeing inflationary pressure, so we're going to keep hiking rates. And I think that's what we're going to see, at least over the next couple meetings. So, and I think at some point, the market's going to fatigue waiting for the Fed to actually pivot. And I think what you're seeing out here right now, I mean, the NASDAQ's up over 2.5% right now. And, I think what you're seeing is the market's already assuming the Fed's going to pivot in either at the next meeting or in the November meeting. So I think the market's incorrect, but right now it's not, you're going to lose money if you bet against the momentum.
Now, when it comes to that, you mentioned how the two things that the Fed often looks at is going to be inflation and unemployment. And it's very difficult to actually understand those two numbers that we see from the government because they're so manipulated. So how does the average person look at how do they actually decode what's happening in the financial system right now?
Well, I think the average person knows the CPI number is total nonsense. I mean, you just have to go to the grocery store to figure that out. But it's not just at the grocery store; it's everywhere. So, I don't know. I don't even know that the average person really spends that much time thinking about the financial markets. They've got their IRA, they've got their housing equity, which is probably going to disappear over the next couple years. And I think as long as as long as they can make ends meet. I mean, obviously the polls show they're extremely unhappy. The majority is extremely unhappy with the government. But I actually wanted to kind of circle back to this idea that the Fed has this dual mandate. And I said supposedly has a dual mandate. And really what I think the pivot, the eventual reversal of their monetary policy is going to entail is at some point there's going to be liquidity issues in the banking system, and the big banks are going to go illiquid again like they did in 2008. And I think we're on the road to that. And one of the indicators that I look at for that is the MOVE index, which is essentially it's the VIX of the bond market, but it's also a gauge of, and there's several different types of metrics that you can look at for systemic liquidity. But this one, it's essentially at its highest level. I mean, it hit a slightly higher level at the beginning of June, but it's at its highest level going all the way back to the 2008, 2009 period. And, I don't have to, I probably have to explain to the Gen Zers what happened back then, but, everyone knows what happened in 2008. And I think my personal view is that what's coming at us in the global financial and economic system is something that's going to be worse than 2008. And we're already seeing in the early stages of the bursting of the housing bubble, we're already seeing numbers that are worse than they were at the early the early stages of the early 2000s housing bubble blow up.
Where do we go from here if those numbers are the same from, where we were back then?
Well, I think they're going to be worse. And I think at some point, the Fed's going to have to start printing money again to re-liquefy the banking system. I mean, like they did in September of 2019 under the guise of repos, that within a month or two they became long-term repos, and they grew in size. And then eventually they had it under the cover of the virus crisis. They were able to dump $3 trillion into the banking system all at once in the form of, it's in the form of reserves. People will say, oh, the Fed doesn't print money, they create bank reserves. Yeah, well, guess what? Bank reserves then become transformed into credit for the entire system, and credit is the same thing as printed money until you repay the credit. Well, the credit never gets repaid. It just gets refinanced. So at some point, you're going to stop seeing refinancings. We've already been seeing that in the asset-backed market, where a handful of companies have had failed asset-backed securities deals that were pulled. We're seeing, the fact that a lot of these banks stopped their stock buybacks when they announced their second quarter earnings. That tells you they're feeling, liquidity pressures, because those stock buyback programs, especially at the big banks like JP Morgan, those things are sacred. And they wouldn't have done that if they weren't worried about their short-term immediate liquidity on their balance sheet. So those are two signs for me that the liquidity in the banking system is starting to tighten up quite a bit. The MOVE index is another one. So.
Now, I know I've had Michael Oliver on quite a bit, and one of the things that he said is if the Fed does reverse to try to save the system, the money won't go into the stock market. It's not going to save that. It's actually going to flow more into precious metals this time, and it's going to be different from when we've seen the Fed create money and expand the monetary system in the past, because we've seen the inflation of the stock market, but that's not what's going to happen this time. Your perspective on that?
I agree with that. And I've been kind of saying, in fact, I think in a recent mining stock journal, I made the same argument that he's making. And it's not just, speculation here. I mean, it's what we saw in 2008 when the precious metals sector got pushed down aggressively all summer. And the stock market was trending lower, and then it had a brief rally while the precious metals were going lower. And then the stock market rolled over, and then all of a sudden in late October, gold and silver started getting a bid. And they had been pushed down to extreme levels back then. And the same thing with the mining stocks. And late October, early November, all of a sudden, a pretty torrid rally ignited in the precious metal sector. I mean, the Amex Gold Bug Index doubled between November and the end of the year. The GDX ETF more than doubled, and gold and silver went on a massive rally. And that while that was going on, the S&P continued heading lower. So the S&P didn't bottom until mid to late March 2009, and that whole time the precious metal sector was still rising. And that's kind of what I expect to see again this time. And what triggers it and when it starts, it's anyone's guess. But going back to the early part of our conversation, I think we're starting to see signs that the variables are being put in place for that type of move to happen while the stock market continues to head lower.
And one of the ways that people can take advantage of that is by investing in mining stocks. And one of the best ways to figure that out, what are the good ones out there, is to look at your journal. How can they find you online, David?
Thanks, Elijah. Investmentresearchdynamics.com is my website. And at the top of that, there's links to find out more information about my mining stock journal and my short sellers journal.
All right. Any last thoughts before we let you go, David?
I think people should just enjoy the rest of their summer and not worry too much about what's going on in the markets. And, if you're thinking of buying a house, I would hold off, because you're going to see much lower prices going forward, and you're going to have a better selection of inventory. And, like I said, just enjoy the rest of the summer, because I think things are going to get dicey in the fall and into the winter. So enjoy what you can while you can, as much as you can.
Sounds good. David, once again, thank you so much, and God bless.
Thanks, Elijah. Same to you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.